What's up, guys? Marty here, and for this episode of Marty World, we're moving a little bit away from the entertainment side because we're going to talk about cryptocurrency and why it's so important that 2021 you get your money working for you. It's a very critical year for the economy and for all of our pockets. More of that coming up. So as you know, due to the COVID-19 pandemic, we've heard a couple of things about, the economy being in a bubble, et cetera, people losing their jobs, and so on and so on. And I'm here to kind of explain to you what a economic bubble is and what you can do about it if you have shares in the stock market, and also what should be next. And instead of being panicked and having a lot of fear about the economy collapsing, actually being empowered and knowing what steps to take to preserve your wealth, but not only that, build wealth for your future. So a economic bubble is a cycle of 5 steps, and usually what it means is that assets grow in a way that points at the economy growing and fluctuating and moving as it should, but in reality it's just fake, and it's for a period of time, and then once you and then once the profit-taking step elapses, we reach panic where the market crashes. And then with that being said, I'm gonna explain to you what a market crash is. A market crash is when shares of public companies dip anywhere between 10 to 20%. Anything after 20%, 21 and on is considered a bearish market and really bad for everyone. But I'm going to tell you how to look at this from a perspective to be empowered and actually know what to do. So first off, if you already have shares in the stock market and some public companies, you have to know how to time the market. And you have to be very smart with your money so you don't lose a lot of it. You have to be okay with some loss that comes with the territory, but also you have to know how to time the market to get out so then you can get in. When markets dip, this is a great opportunity for you to really build on your wealth and actually buy a lot of these shares at a sale price, and that's what happened at the start of the COVID-19 pandemic back in March. A lot of stocks took massive dips. For example, I remember seeing Tesla all the way to 201. I took an advantage there and purchased a bunch of it, and right now Tesla shares are somewhere around 820 or so. That's the main point I want to make about stocks in particular, is that to think about red and market crashing and dips of 20% in a positive way, and opportunities for you to get in the market. As the saying goes, once you hit the rock bottom, there's no other way to go but up, and that applies very much in this particular scenario. The next thing I want to talk to you guys about is not only investing in the stock market, but also looking at cryptocurrency, because I believe this year is a very, very important year in developing and building wealth in the cryptocurrency realm. And as you can see, Bitcoin has already surpassed the $50,000 per Bitcoin side of things, and Ethereum has gone over $2,000, and so on and so on. Before I dive into cryptocurrency, I want to explain to you how it works, and that is blockchain. So what is blockchain? Blockchain, when it comes to cryptocurrency, you're making a request with your buying power to acquire a crypto coin. At that point, your computer, or if you do it through your phone becomes a node within the blockchain, sending that request to the ledger. The ledger, essentially, think about the ledger as a accountant. A common word used is miner. And what they do is this group collectively verify that you accurately have the amount of buying power needed to purchase the coin. after 51% or more within the ledger agreed that you have the buying power, your purchase continues, moves forward to the intended place, and at that point you receive the cryptocurrency, and your transaction becomes part of the block forever. Hence why it's called blockchain, because it's a chain of continuous blocks. Now, when we're talking about cryptocurrency, I want you to stop thinking about it in sort of the way you think about the US dollar or the British pound, etc. I want you to think about it as a finite resource that has a big potential for a store of value in the way gold does. As generations go and resources become more finite, then there's other resources that tend to take their place. And I really believe that that's what we're seeing here with Bitcoin and gold, for instance, and why it's growing so massively. It has proven now that it has a significant store of value potential to keep growing, and the way that these guys have created or developed these cryptocurrencies is in a way to prevent inflation. And how do they do that? The way they do that is by capping the amount of coins that can be circulating at any given time. For example, right now we know that there's approximately 18.6 million Bitcoins fluctuating in the market, and the market cap is 21 million, which will be reached sometime 2140. So a long time from now. But I'm here to tell you that more importantly, besides Bitcoin, there is several other altcoins or alternate coins that have a huge potential for growth that can really make you some money this year. And the reason why these coins are developed is because they're designed to back the technology behind them. So when you look at these altcoins, what you want to do is look at the technology behind it, look at if there's a demand for it, and more importantly, I think this is very vital, look at the team that's behind it and what is their experience. And with that comes giving you an advice on what you should do to become a successful investor that builds wealth and generates income. One of the things that I do personally is what I call the rule of 4 rules. This is something that I personally made up because with my background in the military, I know that process that are successful tend to be deliberate. So they are built in scalar motion where they build on top of each other. And my personal number 1 rule is be disciplined. And with that comes is that you should be in a place that when you're making trades, when you're purchasing in the stock market or when you're purchasing cryptocurrencies, that you are in a place that you are confident about your investment and that you're not going to get in panic or fear and sell because you see a little bit of dip in the market. My second rule is invest within your circle of confidence. This is from the man Warren Buffett himself. And what that means is that when you're investing, you should invest in companies that you do understand. If something is too difficult for you to understand, that's completely fine. You just should not invest on it. Rule number 3 is look at the total amount of demand. In regards to cryptocurrency, you have to look at what this technology does and what is the prospective value of it. When it comes to the stock market, the industry that the stock is in and what is the estimated percentage of growth within that industry. And last but not least is know your CEO, know your 10K, your 10Q, and your estimated percentage of growth or revenue. And what that means is if you don't know who the leadership is from the company, you should not invest in that company. You should get to know the CEO, get to know their background, and really build confidence in the fact that you trust that this guy is the right guy to move a company in the right direction. Pointer that I can give you guys is that when you watch a lot of the news, they really rely on fear because they know that fear creates clicks and clicks generates income for them via ads or whatever else. So just be very disciplined, going back to that rule number 1. And then number 2 is that if you look a lot of financial advice and financial guidance and you read a lot, they're going to talk about diversification. And I agree, diversification is very, very important. However, if you diversify a lot, they're going to tell you that that's the way to generate wealth. And I'm telling you that if you do that, you're going to make absolutely nothing. Because Warren Buffett, the man himself, said that diversification preserves wealth. Now, concentration generates wealth. And what that means is that when you're looking at your portfolio, and depending on the money that you have in the stock market and stuff, you should really have what I called the 70-30 ratio. It really depends on age brackets, but for the purpose of my age bracket, I'm going to give you but the 70-30 ratio is that within my age group, which is 21 to 30, I'm going to invest a significant portion, 70%, of my investments in companies that I trust, which should be 1 to 3, nothing more. Big companies that I have a lot of trust. I know the CEO, I know the reports. I know that I can put a lot of trust in those particular companies and that they're going to generate the wealth that I want. And then the other 30% is for riskier shares of public companies and riskier stocks with a little bit more volatility, but also with a potential of growth that is significant, which means that the risk and the reward sort of align. Then as you get older, you want to kind of dwindle down those percentages to 80-20, and then ultimately to 90 and 10. Last but not least, just recapping this video, remember circle of confidence. Remember, create those 4 rules that are going to be really important for you. Remember your ratio. Your ratio should be, if you're somewhere between 21 and 30, 70-30. If you're older, 31 and up to 50 should be somewhere closer to 80-20. And also remember to be disciplined and to know the companies that you're investing or the technology that you're investing on, so that way you're not a guy that is investing with fear of losing money, but you're empowered. So if you guys like this video, please like and subscribe and let me know in the comments. I'm thinking about making a video of the 6 altcoins that I think are gonna hit big this year and next year. Let me know in the comments. Let's keep this going and let's keep making more videos about financial education. Until next time, Marty out.